Hey everyone, welcome back to Corporate Decoder, the place where we take confusing business reports and make them easy to understand. Today we're diving into Walker & Dunlop's latest quarterly report, and let me tell you, after seeing these numbers, their shareholders might need a strong cup of coffee or maybe something stronger. This report shows the company's performance for the first 3 months of this year, and while some areas look okay, others are raising some eyebrows, especially for their profits. Before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below for even more discussions and insights. This document is for the period ending March 31st, 2025. It's a Form 10Q, which is a quarterly report that public companies file with the Securities and Exchange Commission. Basically, it's a check-in on how the company is doing. Let's start with the basics. Looking at the balance sheet, Walker & Dunlop had total assets of about $4.5 billion. That sounds like a lot, and it is. What really matters is how this compares to what they owe, the total value of what they possess. Their total liabilities were roughly $2.8 billion. This means they have a bit more in assets than liabilities, but the debt is significant. Now that we have the financials out of the way, let's see if we can find out any interesting details in the document. It seems like Walker & Dunlop is having some trouble getting paid, because their net receivables or accounts receivable went up from $335.8 million to $372.6 million between the end of last year and this quarter. That means the company is waiting to receive $372.6 million from customers. Moving over to equity, the total value of all the stock that they have is roughly $1.7 billion. Now for the real juice, let's check out their income statement. Their loan origination and debt brokerage fees, which is the money they make from arranging loans, is about $46.3 million. Placement fees and other interest income, which is the money they make from investing excess funds, total to approximately $33.2 million. Looking at total revenue, this is where it gets interesting. They brought in $237.3 million. Now let's look at what they spent. Their total expenses hit $23.1 million, meaning the income from operations ends up being $5.2 million. And after subtracting their taxes, the net income for Walker & Dunlop is a meager $2.7 million. Basic earnings per share comes out to about 8 cents a share. While last year at the same time, it was 35 cents a share, more than 4 times this year. Not a good look. Digging a little deeper, the benefit for credit losses is over $3.7 million, meaning they allocated more money in case people don't repay loans. The company's comprehensive income, which is just net income adjusted for certain gains and losses, looks even worse when we compare to comprehensive income for the first 3 months of last year. It went from $11.8 million to $3.4 million. This isn't only because of business operations, but due to how they mark their pledged securities. Let's look at the cash flow statement to see where the actual money is flowing. Cash flow from operating activities came out to negative $281 million. Cash flow from investing activities was negative $39.3 million, while financing was positive at $222 million. As means they are spending more than they earn from their normal business and investments, but getting cash in from financing, which may not be sustainable in the long run. Here is a note about potential loan repurchases. Walker & Dunlop is obligated to repurchase loans that are originated for the GSEs. But in this report, they have only repurchased 3 of the 5 loans that they were asked to repurchase. This shows some risk of loans that the company has that might default or need to be repurchased at the company's expense. There are key economic assumption sensitivities that you should know. These sensitivities detail how the company might change based on economic indicators. To start, if discount rates increase by 1%, the company's assets would decrease in fair value by $42.1 million. I am skipping some accounting terminology and details, but here we have the business segment results. Here, their capital markets lost $6.7 million versus a profit of $13.7 million in the same period last year. This sounds like a bad sign. The losses can be largely attributed to decreases across origination fees, property sales and placement fees. The company authorized the repurchase of about $75 million in stock, but did not repurchase any stock. The document states that they have no defaults upon senior securities. I am skipping more legal details and some accounting jargon to get to the meat of things. Or for the debt agreement, we can see that they plan to pay at least 0.25% of the principal on a quarterly basis. For the non-financial numbers, they had a huge net change in unrealized gains due to pledged securities and tax stuff. To explain it simply, it means the company is putting a bit more capital aside due to tax requirements. I am skipping a lot of details, but the gist of the filing is that the company's results of operations for the 3 months ended March 31. 2025 or thereafter evtura emtisevely indicative of the results that may be expected for the year ending December 31, 2005 or thereafter. So what's the bottom line here? Walker & Dunlop seems to be facing some challenges in this first quarter. While revenue is up a bit, expenses are up significantly, leading to a major drop in profits. The large debt balance and potential loan repurchase obligations add some risk to the situation. On a good note, transaction volumes are up, which gives a positive outlook for the year. This also means that hopefully they will bring in more profit to service the debt and equity under management off. Subscribe, more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.